Hi, my name is Nick Grantham. I'm a CPA in Texas, and today's video is all about QuickBooks Online and how to look at these reports that you have access to. We've done videos on reconciling the bank accounts, categorizing transactions. This video is kind of on that step two. Once you've done that, how do you look at these reports and understand what you're looking at? This is great for new business owners, maybe small business owners, somebody who's trying to get involved in their business's books and they don't have a background in accounting. This video is for you. So today we're going to look at three reports: the profit and loss or the income statement, the balance sheet, and the accounts receivable aging summary. So let's dive in. Like I said before, generally the first thing that you do when you set up your QuickBooks is you connect bank accounts, you connect business credit cards, and you're going to do the bookkeeping part or the categorizing of all the transactions. So in QuickBooks, if you go to the accounting tab and bank transactions, this is where you can connect your bank accounts, and then every single transaction your business has will flow through to the register, or I'm sorry, to the bank feed rather, and you'll categorize them into the bank register. Once that is done, you'll reconcile each account month by month. So before you even look at the reports, you have to make sure this is done, because if you pull up a report and you haven't done the bookkeeping part of this, then that report means nothing because the data is bad. So, like I said, we have some tutorial videos on this part. Check out the description below, and let's dive in now to the reports. So, first and foremost, the report most people want to see is their profit and loss. So, if you go to reports and standard reports, QuickBooks generally has the three reports we're talking about today starred as favorites by default. If not, for some reason, you'll find the profit and loss here under the business overview. Again, you may hear me refer to it as income statement. Same thing. In QuickBooks, it's called profit and loss, but it's the same thing as the income statement. So that's what we're looking at first. So if we open this up, QuickBooks is really great because you can categorize this super simply by periods in time. There's a lot of comparison tools that are here. I'm going to kind of dive into those. But first and foremost, for those who don't know, the income statement is a report that's a date range. Okay. So when you pull this up, you're gonna select a date range and you'll look at this report over said date range. The date range could be today, or it could be this week, last month, last quarter, last year, this year. I mean, you select a date range. You get what I'm saying. Now, as we just saw, if you looked in the bank transactions section, we have these accounts here, and we have transactions for 2026 that have not been categorized yet. So when I go to my reports and look at this income statement, you'll see if I run it to the current date, this year to date, well, this info is bad because I haven't categorized all of April or the beginning of May yet. So yeah, this means nothing, right? So I need to set a date range that makes sense based on the bookkeeping that I've done. And in today's video, we're going to look at last year. We're going to pretend that we're doing our tax return. So we need to pull up our income statement for last year. So let's pull it up last year. And this this is now going to pull up the profit and loss for the past year. This is the data typically that we're going to use to do our tax return, especially if you're a sole proprietor, a single member LLC. This is going to go on your Schedule C on your 1040 tax return, and this profit and loss is the key to all of that. Okay, so you may be wondering, what am I looking at here? I've got my date range. That makes sense. What is this accounting method? Okay, you have two options. QuickBooks will generally pull it up by accrual as the default method. What accrual means is that's going to be if you're invoicing, for example, then the moment you send that invoice, it gets posted to your sales. Whereas when you switch to the cash method, you're not going to see that sale in your income until it's been deposited to your bank account. So same thing goes for expenses. So if I have a bill that I enter into my QuickBooks, even if I haven't paid that bill yet, because it got entered at a certain date, then that's when it's going to show up on my financials. So most small business owners will typically file their tax returns on the cash basis or the cash method because it makes more sense and it's easier for small business owners because simply it's, hey, when did I collect this money and when did my expenses leave my bank account? So for today's video, we're going to pull it up on the cash basis, all these reports. So this fake business of mine, Craig's Design and Landscaping Services, is a sole prop. I'm going to pretend it's a single member LLC and I'm filing a Schedule C on my 1040. And I've finished reconciling. My accounts are all clean. And now I'm just looking at my reports for last year. So you can see here I do landscaping and pest control services. This is my gross income. So I grossed about $468,000 in 2025. But then I have all my expenses. So I'm not paying tax on the $468,000. I'm paying tax on the net. So as you can see, this is really what I need for my taxes. I've got my gross sales and then all my expenses. I had auto expenses, I had, bank fees, commissions, dues and subscriptions, maybe for software, different things. I had insurance, some type of general liability insurance, maybe auto insurance, things like that. This was my cost of labor. I paid some contractors. I had to have some maintenance and repairs done. I had job materials such as supplies, plants, soil. I had paid an accountant. I paid a bookkeeper. I had rent. Maybe this was equipment rental. Maybe this was for office space, supplies, taxes, licenses, travel expenses, my cell phone. So I've got my expenses in here. And ultimately, I can now see, okay, this is how much money I made. Yeah, it's great to be able to see my gross. This is how much I billed. This is how much total business I did. But from what did I take home? What did I actually make? Well, that's going to be this net income number. The other great thing you can do is you can compare it. So I can pull this up month to month. I'm going to do quarter to quarter in today's example here. And now I can really look at the trend quarter to quarter. So you can see here, man, quarter two was really, really good. When we got into that spring and summertime, that was my best quarter for the year. And then late summer and fall kind of were a little bit slower, but really, as you can see, the worst quarter was quarter one. And maybe that's when I just started my business. Maybe that's because it was, winter months. But you can see here, man, I did really good in quarter two. And just knowing that from a business standpoint might help you realize, hey, I need to do some advertising and marketing in the winter, in those early months of the year. So there are great insights you can get just by looking at the trend analysis. Same thing goes for expenses, right? So you can look line by line and say, I made the least amount of sales in January through March, yet that quarter was my highest automobile expense quarter. That's weird. Why was I spending more on fuel and automobile expenses in the quarter where I made the least amount of sales? So things like that you can look at and kind of realize maybe there's a way I can become more efficient in my business. And you can kind of scroll down, look through these to compare and see if things make sense, see if something stands out. See, as you can see, insurance is the same every quarter. So this kind of makes sense. Like you're paying month to month for some type of insurance. So that looks good. Your cost of labor kind of makes sense. It was less in quarter one, and then it was at its highest in Q2, but that's also when you made the most. And then quarter 3 and 4. So I might look at that and say, I was able to be a little bit more efficient in quarter 4 because I made about the same as quarter 3, but I paid a lot less to my subcontractors. So just good info to kind of gather by looking at trend analysis. Same thing here. You can see, hey, I made less sales in quarter 1, and that was also where I had the least amount of materials. But man, I paid a lot for plants and soil. Why is that? Maybe it's because I was gearing up, soil for future projects that I ended up using in Q2, Q3. So you can kind of draw conclusions and make sure something isn't off by looking at the trend analysis. And then you can see here accounting. Okay, it looks like I'm paying an accountant maybe monthly, maybe quarterly, but man, it jumped up $2,000 in Q3. Why is that? oh, it's because I paid them for my tax return that I filed late last year. And so that all hit in quarter three. So you can look, and this is just great detail to be able to see how your business does and kind of how efficient you're being throughout the year. But as far as your tax return goes, you'll just look at it for the whole year. And ultimately, you will take this data, and this is where you will kind of determine what your tax is going to look like, even for projecting. Hey, I'm like, for example, if we were looking at this in the middle of the year last year, and because we were trying to figure out, hey, I think I need to make a tax payment. So if I ran at 1/1 of 25, and maybe we're looking at this on for that let's just say we're looking at it at quarter one. So through the first quarter of 2025, I could see, man, I've made 15,000 in quarter one, right? So at that point in time, maybe it's getting close to April 15th, and I want to make that first quarterly estimated tax payment. Well, then I could just basically it's about 16,000. I could simply take 16,000 times four quarters, and assume, hey, I'll probably make about 64,000 in net income this year. So I need to plan on paying some tax based on that number. I'm going to owe my self-employment tax. So I'm going to multiply that by 15.3%. So, I'm going to owe almost 10,000 just in self-employment tax. Plus I'm going to owe federal income tax in whatever brackets I'm in. So I can then kind of take that. So let's just pretend like let's say we've kind of calculated it, and I'm going to owe 15,000 is kind of my thought. Well, then I could divide that by 4, and I could pay in about $37.50 for quarter one. But then at quarter two, which is really a little bit earlier for the IRS, that is due June 15th. So we'd run it through May 31st, and we'd see, man, my net income is quite a bit higher than I thought. It was 16,000 at quarter one, and now only 2 months later, we're at 86,000. Goodness. Well, what's 86,000? 581 divided by the 5 months we've had so far times 12 months. So maybe I'm going to make more like 200,000. Wow, I really picked it up this quarter. So in this case, I may owe quite a bit more tax. I may owe 40,000 in tax. So maybe last quarter I only paid in 3,700. Now I'm thinking I should have paid in 10,000 a quarter, so I should probably pay in 15,000 this quarter. And then you get to quarter three, and you run it again, and it's like, oh, actually, let's see. Actually, maybe I'm not doing quite as good as it looked like last time. 128,000 divided by 9 months times 12 months. Okay, so maybe instead of 200 plus, I'll be at more like 170. So you can kind of throughout, as long as you're keeping your QuickBooks updated and reconciled, you can use this data to get yourself a ballpark of where you're going to land. Okay, so that's the income statement in a nutshell. The only other thing I wanted to mention here is if you're a single member LLC, if you're a partnership LLC, if you're a sole prop, and this is your main operating business, and you're netting this much, which is almost 160K, and really, we recommend it generally over, if you're netting more than 50K consistently, it might be wise to consider having your LLC taxed as an S-Corp. We have another video about that. Check it out in the link below if you have questions, but you can potentially save yourself a lot of tax by having your LLC taxed as an S-Corp instead of as a disregarded entity on the Schedule C, because the Schedule C, all this net income is subject to self-employment tax. Whereas if you're the S-Corp, you get to split that up between salary and owner distributions. And ultimately, only the salary piece you're paying that Social Security and Medicare tax on versus self-employment tax on the full amount. So we've got another video on that. I just wanted to bring that up because this is a lot of net income to show on a Schedule C. Okay, so this was the profit and loss or the income statement. The next report is the balance sheet. So on the balance sheet, it's not like the income statement where you're looking at a date range. Instead, you're looking at a moment in time. It's a little confusing on QuickBooks because it pulls it up as a date range. But basically, whatever the to date is, the latest date is the point in time in which it's showing it to you on QuickBooks. And you can see that even here, it says as of May 7th, 2026, even though my date range is selecting this year to date. So for example, if I want to look at last year, this pulls up the full year here, but it's showing you values as of December 31st of 25. That's how we want to see it. What this date range ultimately means is like if I drill down on one of these accounts, such as like accounts payable, it will then only show me transactions from that date range when I drill down. And this is just this is like a fake QuickBooks here. So there's just not a ton in here. But if I were to drill down, I might see all my deposits for the year, and I could change this to like all dates, and it would show like everything from 2025 and 2020, all dates. Maybe it goes back 10 years, who knows? But ultimately, when we're talking about our tax return for last year, we want to pull this up for last year, and we're looking at the last day of last year. With the balance sheet, and we'll switch it to cash method as well. With the balance sheet too, what's helpful is you can compare it to a prior period. So like if I want to compare, hey, this is what all my balances were on December 31st, 25, but I want to compare that to the year before, previous year, like this. And this is a new, so unfortunately, this is the first year, so there's nothing to compare it to. But what's nice about this is you can see in this column, how much did it change by? So like maybe, in fact, I'll just run it this year to last year just to show you. So if we can pretend like this year's data is up to date. And then I could see like, okay, it's December 31st, 26. I have 120,984 in the bank. At this time last year, I had 123,000. So my bank account's roughly the same. Like I'm I guess down $3,000, but it's very close. And look, I've got undeposited funds. So really, that's the difference almost. And this is just, some funds I collected, and I've got a check sitting in my pocket, and I need to take it to the bank. But basically, I have about 123,000 as I did last year. So this is nice for comparison. But anyway, if I'm just looking at for my tax return, if I bring back up last year's balance sheet, these are my totals. I'm going to take off the comparison here. And I basically, the only thing I have on here is I've got a checking account, and I've got, let's see here, owner. This is an owner draw. So this is like money that I took out to pay myself, more or less. So like, yeah, I made 158K, and I took out about 48K as distributions or owner draw. That's like money I took for myself. Another quick thing on taxes, doesn't matter how much you take out, it matters how much the business netted. So you're going to pay tax on that full 158K, not necessarily just the 48K that you distributed to yourself. So even though you've got a bunch of that money still sitting in the business bank account, doesn't matter. You pay tax on that net income in the year it's made. So maybe in 2026, I don't make as much, but I take more out, then that's fine because I made that money last year. I paid tax on it last year. All in all, this is the balance sheet. It'll show your assets on the top and then your liabilities and equity underneath. Not the best example in this sample company. If I change it to this year, we've got a little bit more to look at here. So you can see I've got a checking account, a savings account. These are my balances. Undeposited funds, this is that check that a client paid me. I haven't deposited it yet. Fixed assets, this is a big one for your tax return. This is a truck, and I paid $13,495 for it. However, it's not on my income statement. It's on my balance sheet. So how do I get to write this off on my taxes? Well, we add it to a depreciation schedule, and we start taking depreciation on it. But in QuickBooks, there's no accumulated depreciation. It looks like I can click on this. I can see when I added it to QuickBooks. In this case, it got added in 2026. For the sake of today's video, we can let's just pretend it got purchased in 2025. So what we're trying to do is add that deduction to our tax return. So what we would then be able to do is basically we could prep our tax return and figure out how much depreciation we're going to take. If the truck is over the 6,000 gross pounds, we can write all that off in 2025. So instead of the 158K, we can write off 13,495. So what I could do is a journal entry, and let's just pretend we purchased it in August of 25, and I could take a depreciation expense deduction for the 13,000. That may not be the right number, 465. And then there's usually an account called accumulated depreciation, which I don't see here. So I'm going to create it. And that's basically just a fixed asset account. accumulated depreciation. It wants it to be a sub account, so I'm just gonna call it buildings. It doesn't really matter. Okay, so then when I look at my balance sheet, what that just did is it shows, hey, I bought this truck. Oh, I was $30 off. So I bought this truck for $13,495, and I'm writing all that off in 2025 on my tax return. So I want my QuickBooks to match my tax return. So now when I've added that journal entry in here on my balance sheet, you can now see, hey, I bought this for this price, but I wrote the whole thing off. So my tax basis in it is 0. And then on the liabilities and equity side, this shows obviously, hey, this is the balance of my MasterCard. I've got a loan for something that I need to pay off. I've got another loan here. So I've got a couple loans that I'm making payments on. That's how I got some of the cash in the bank account, maybe. And then opening balance equity, I've done a video on what this is. We'll put that in the description below. Opening balance equity, this is actually generally like a mistake and it needs to be corrected and zeroed out. So I've done another video on that. I don't want to spend time on that right now. If you're interested, please check it out below. And then ultimately, this is owner draw. This is the money I took out. And then this is my net income, and then the prior year retained earnings. We're looking at this in 2026. So in 2025, this number dropped once I added that depreciation. So real quick, if I go back to my income statement or my profit and loss and I run it for last year, what I've done is I have added depreciation down here. So now instead of 158K, my net income is actually a little bit less. So this helps me out on my taxes. All right, last report is Accounts Receivable Aging Summary. And this is a super quick one to look at, but really what this does is it allows you to just kind of keep an eye on the clients that owe you money. And you can run it as of today, or I could say like, I want to run it like as of like, say last month, for example. Let's see, last month. So as of April 30th of 2026, these clients owed me money. Have I collected, like basically anything in the 1 to 30 column or current is like very, pretty newly sent invoices. But if I start seeing things in this 31 to 60 days, 61 to 90, and especially 91 and over, this would be invoices that you sent out and they've never been collected and it's been over 3 months. So that stuff we need to consider, hey, do we need to write this off? Or hey, do we need to kind of follow up here and get this collected? This is super important to keep an eye on to see who owes you and what you still have out there to collect. So that is the conclusion of our video today on these different reports and how you can look at them and learn from them and analyze how your business is doing. If you found today's video helpful, we'd love a subscription and a thumbs up. Leave a comment below for any future video ideas. And again, thanks so much for watching.